Welcome to your daily 5 minutes market brief with JPMorgan and Luna. Today is July 10th, 2025. I am Luna.
I am JPMorgan. Indeed. It was quite a day. We're looking at U.S. stocks hitting fresh highs, which is remarkable, really, when you think about the headlines. You had trade wars heating up, talking about monetary policy. It's just a prime example of the markets trying to digest these really mixed signals. And what's fascinating is just how resilient U.S. equities were, despite some pretty big geopolitical stuff happening.
Right, that resilience. Let's maybe unpack that a bit. Especially in tech stocks, it seems almost, counterintuitive given all that noise. From your perspective, what's really driving that strength in U.S. equities right now?
Yeah, it's a really interesting dynamic. The sources we looked at suggest these broad gains, particularly in tech, kind of reflect flight to safety, but safety into, perceived quality, which is tech right now for many. And traders seem to be showing what you might call tariff fatigue.
Tariff fatigue?
Yeah. It's almost as if the markets learned to tune out some of the headline threats, maybe.
Yeah.
They're largely shrugging off these new trade announcements, perhaps banking on growth staying strong, or maybe thinking these are just opening bids in a negotiation.
And speaking of tech, the numbers were pretty striking. The NASDAQ composite jumped almost a full percent, a record high, 20,611. And that huge milestone, NVIDIA, briefly touching $4 trillion in valuation.
The first company ever.
The first ever. And the S&P 500, the Dow, they also had solid gains. Microsoft, Amazon up around 1.4, 1.5%. Does that kind of surge, especially concentrated in tech, tell us anything deeper about the quality or maybe the risk appetite of this rally?
Well, it certainly highlights the market's conviction in, innovation and growth. Even with all this uncertainty swirling around, it suggests investors are actively looking for companies with strong earnings potential, companies they think can weather these broader economic storms. But, it definitely raises that important question. How long can the markets truly ignore these escalating trade tensions, even if individual companies look strong?
That really is the million-dollar question, isn't it? Because our source digs right into President Trump's announcement, new 50% tariffs, specifically on U.S. copper imports and also all goods from Brazil, both set to kick in August 1st. And we saw immediate reactions, right? Copper futures surged, Brazil's currency, the real, plunged nearly 3%.
Absolutely. Those actions show the immediate direct impacts you can get on specific commodities in emerging markets. It's quite stark. And yet, as we just talked about, the broader U.S. equity markets, surprisingly resilient.
Holding up.
Exactly. So there's this underlying hope, or maybe it's an assumption, that negotiations could still sort of diffuse the worst outcomes before that August 1st deadline. But make no mistake, if these tariffs do go into effect fully, they could certainly pose real inflation and growth risks down the road, raising input costs for some vital sectors. It's a really delicate balance right now between that hope and the potential reality.
Okay, but underpinning all this market movement, of course, is the Fed, the Federal Reserve. Their June FOMC minutes just came out. That's the committee that sets interest rates. What did we learn about their thinking? Are rate cuts coming soon?
Well, the minutes actually showed a bit of a mixed bag, maybe more mixed than some expected. Only a couple of officials were pushing for a rate cut in July. Most seem to prefer holding off until later in the year. And the reason? Persistent inflationary pressures. They're still worried about that.
Still sticky inflation.
Right. The general consensus seems to be that, yes, cuts are likely appropriate later in 2025 if inflation really does cool down, which aligns with what the market's pricing in, about a 50-60% chance of a September cut. So this nuanced stance, it sort of calmed fears of a really hawkish Fed, one super aggressive on keeping rates high. But it's also a subtle reminder. Rate relief depends very much on getting inflation clearly under control.
And one last piece here. The Treasury market. A strong 10-year Treasury auction apparently helped calm yields. What does that signal about investor sentiment towards safety?
Yeah, that was significant. It was a $39 billion auction, and the demand was quite robust. We saw the 10-year yield settle around 4.34%, which was down about 6 basis points. That's 0.06 percentage points. It basically signaled that global investors still see U.S. Treasuries as an attractive safe haven, which helps ease worries about financing the growing U.S. deficit. And those lower long-term yields, they give a direct boost to rate-sensitive sectors. Exactly, like high-growth tech stocks. It helps underpin those high valuations we were talking about. It's just a clear reminder that demand for safe assets can pop right back up when yields look attractive, especially for investors looking to lock in returns.
So, putting it all together, what does this mean for you listening in? The last 24 hours seem to have reinforced this kind of Goldilocks narrative for the U.S. markets, right? Not too hot, not too cold, but it seems less about everything being just right and more about the market making a very specific bet. A bet on the Fed managing inflation without killing growth, and a bet that these trade tensions will somehow stay contained. Investors are clearly, as the source said, hungry for riskier assets.
Precisely. And while the path of least resistance has definitely been upward lately, the fragility of that Goldilocks scenario is really key here. It feels fragile. The trade conflict could absolutely reignite volatility if those talks break down before August 1st. And Fed policy is still uncertain if inflation surprises on the upside again. Plus, those market valuations, especially in tech, they are undeniably high.
So for you, the learner, maybe the key takeaway is enjoy the games, sure, but stay vigilant. Monitoring the news on trade talks really closely, especially as that August deadline gets nearer, and keeping an eye on what the bond market is signaling. That seems crucial right now for understanding the market's real footing.
Yeah, absolutely. And maybe something for you to mull over. In a market like this, where the positive feeling is strong but also feels quite fragile, what specific steps can you actually take in your own planning? How do you make sure you're not just riding the current wave, but you're also strategically prepared for whatever that next potential plot twist might be?
Enjoy the brief? Please like and subscribe. From equities and bonds to global risk sentiment, we deliver day's key market moves, macro trends, and institutional flows in just 5 minutes. Live stream coming soon. Stay tuned.